Hello everyone. So I was having a very friend suggested me that I make a small video on basically what investment can be and what investment is in general terms and how you can understand it from both the finance point of view as well as the economic point of view. Now, essentially, if you look at the word investment, it basically means you're putting your effort into something. So, in the most simplest of terms, you could define investment as a addition of efforts to achieve something. Right. Now, if this is the context, if you look at the way economics treats investment, economics treats investment as a portion of, I would say, the money that people have is being put to productive use, be it building factories, be it building businesses. You can set up a business somewhere in your city that adds to the investment. So you would say that in economics point of view, investment is treated essentially as a net addition to the capital stock. Now, what is capital stock then? Capital stock is essentially that amount of technology that is existing today, and any addition to that to increase the output would be termed as investment. So if you take K1 to be the capital today and K2 to be the capital that is to be invested tomorrow, the difference is going to be the investment. So you represent it in general economic jargon as delta K, which signifies a change or an increase or a decrease. You can be bold. It, it defined as investment. Now, investment, if you look at it in a much more broader sense, it's not just the amount of the addition that you make. So, if you, in the Keynesian framework, if you take a current model of economics calculation that is made, it is seen as an addition at a very big scale and driven by savings. So in India, particularly, unlike in the US, where the savings investment relation, so if you save so much today, that investment is that saving is transferred to banks in terms of deposit that you make, and that is again lent out, which is again used to productive uses. So business take loans. So this channel from households to banks to businesses, that is what is the investment channel that you identify in most of the developing countries. And that is not so much the case in developed countries because investment is more from a corporate view, which is having a certain amount of funds utilized and they use. You find that in America and in England and in Japan to some extent. I'm not sure about Japan, but America and England, you find that a certain amount of money that is invested is not routed through the banks because the savings are low. In India, on the other hand, the savings are very high. At least a third of the GDP is funded through savings. I mean, savings to GDP ratio, if you take it, that has to match the investment to GDP ratio. So rate of investment should be equal to rate of saving to enable a sort of an equilibrium to happen in the investment market. So this is the economic side of it. So if you have to, so if you take it to be much more simpler, you can find it as a net addition to create something new. So if you are having an additional investment to be made, that means you are expecting some result out of that at a certain amount of return. So that is what is investment in economics terms. So you have to have, as if you have 50 rupees, if you keep it idle, there's no point of it being, if you keep it idle, there's no way out, right? So you have to use it in a different way. Now, borrowing from this, I would like to delve on the financial aspect of investment. Now, financial aspect of investment is usually seen through the lens of banks. If you put so much money in the bank and it'll be so much, it'll be giving you this much rate of return in the markets. It depends on the market system, etc. So if you can see that there's a clear distinction as to what markets and as to what economic treats and how it treats investment and how uh, finance world treats investment as. If you and the difference is very clear. Economics, it's a macro concept. But in finance, it's a micro concept because it's all dealing with your money and at the local level. How are you investing? Where you're investing it in stocks, you're investing it in bonds, you're investing it in mutual funds, you're investing it in securities of government or whatever. So if you invest, say you get a first salary at 50,000 per month. Out of that, you separate the amount of taxes that you have to pay. If you separate the taxable amount and you have whatever is left as a disposable income, that means if you are able to use that income to, you can dispose that income to meet your needs. So that amount of income, if you take it, that is to be sort of put somewhere, right? You can't just have it in bank throughout. If you want to have a certain amount of return, which is going to increase your amount of the income that you can save, the only option for most people would be to invest it in something. Banks are not a really preferred arena of investment because at least in today's world you have a certain amount of security versus a certain amount of risk. Because and this is where the investment channels emerge. You have a bank, you have a certain amount of types of deposit, fixed, recurring, savings, current deposit. You have a certain amount of rate of interest accruing to you in different accounts. Different banks have it. So average, if you take it, there's not much of a feasible return in the sense it's not very attractive or not remunerative enough. So you would not find people investing much in bank deposit, putting money in bank deposits, because and it will have only a given percentage of increase every year. So you would want to route it into something else. You might put your, say, if you get 40,000 or 45,000 you have out of 50,000, if you have some original example that I took, or 45,000 you have. So where do you invest it in? How do you invest it in? You have stocks, you have bonds of the government, of the companies, of many companies that issue bonds. For those who do not know, the difference is this. When you sell stocks and buy stocks, it's a very clear picture that you're buying a certain amount of company share and you're selling it. That is a normal buy and sell. But when it comes to bonds, bonds are essentially a case wherein when you buy bond, it is actually a case where you are putting your money, right? So if you, it's much like a share. Rather, the difference is those who issue bonds are liable to pay you back, pay them back, and sometimes you have cases where the bond market is not very comfortably, I mean, not very well placed. So you would have it, people running to stocks. But and in general, people prefer banks over, I mean, if you wanted to put in a very simple terms, risk averse people, I mean, those who are not really fond of having so much volatility and they're scared of volatility, you would find them putting their money either in banks or government securities because government securities are guaranteed. So the government cannot default on its payment of bonds. So you can find them putting it in bonds, government bonds, because government bonds are essentially those which companies, public sector undertakings release to get funds. So if you have, say, take the ONGC for instance, Oil and Natural Gas Corporation, it needs a certain amount of money for a certain period. So now it has to fix a certain amount of money that it needs and it creates a certain amount of interest. So now it is your call whether you would actually want to put it in that bond or you want to put it in stock, or you want to put it in bank deposit. So the choice is yours. You can't have any this thing. So you have to have a certain clear understanding as to what stocks can, what kind of stocks exist, and what kind of mutual funds exist, and what kind of bonds exist, and what kind of bank deposits exist, and what different rates. And which is secure, which is not, is a call that you have to take. And moving on, I'd just like to add one bit and finish this. And that is essentially you take, excuse me, you take, for instance, in the 2008 crisis, when we had the global financial collapse, what we found was people were actually going out left, right, center to buy certain property, etc. So your investment can also be in property and gold. Gold is the most safest investment there can be because gold price always goes up, it can never go down. And because gold's value is going to only go up each time. And you can't find a case where the gold's value has actually fallen unless it is linked to something else. But usually currencies are linked to gold rather not to gold to currencies. That is a clear distinction you have to draw. And I will also add that if you were to make a certain amount of investment, uh, you have to understand what are the other bodies that you can get in the middle of it. So you have, for instance, for stock market, for capital markets, you have the regulator, which is SEBI, Securities and Exchange Board of India, and you have for other, you have the RBI for the banks and non-banking finance, mutual funds. All these are regulated by the RBI. In any case, if you have a default, etc., you have to approach the banking ombudsman, which comes under the RBI. And SEBI is a statutory board, so you have to approach SEBI if you have having problems with stocks. If you find, like in Harshad Mehta's case in the 90s, when a stock price artificially rose up due to interbank transaction problems where money was routed from banks, from interbank transactions, put in stock markets, only to drive up the price of the stock markets. This caused such a furor that you found suddenly one day the price dropped like anything. Everybody loses amount. I mean, the amount of money swindled it goes to 1,000+ crores. I think 5,000 crores, if I'm not wrong. So the element of risk is inherent in stock markets and in mutual funds, because mutual funds, where what happens is you put a certain amount, they use that money and put somewhere else and then give you a return. So it's like a mediation in between, more like a broker. Rather, it's not just you there. There's so many amount of people out there. So it's all a question of probabilities and possibilities and also risk. And on that note, I would like to say that don't compare the investment that you make in economics as you cannot draw a correlation between them. What you can instead find is this chunk, this finance element or financial investment that you have, but it's around a certain amount of, you can say it's a portion of the overall investment that you find in an economy. And a very important thing that people don't really understand is stock market do not have at any level any predictability of the economy. So you cannot be guided by stock market to understand what the economy is, how the economy is doing, because there's a fundamental difference, and only listed companies can go and invest in the stock markets. And that does not mean the economy is, for instance, you have a case where in the current times you are having the stock market going up. Today, Sensex went up to 50,000, which is a record, and now it just, but the economy, everybody knows, it's floundering, it's stumbling, it's not having even the proper growth rate. So, where is the correlation between the stock market's performance and the economy? The answer is zero. So on that note, I hope you all take a clear picture. If you understand what the differences between the stock market functioning, how capital markets work, and how investment per se is different in different areas. And that's all I have to say. And I hope you like this video. Thank you for watching.